And welcome everybody to the podcast. Today we have a very special episode today that I'm super excited about. Today we have with us William, who's my oldest child. Yeah, William. I have a daughter as well who's a couple years younger, but my son is 13 years old, going to be 14 in May. And the reason why I'm having him on here is because he has expressed interest in finances, stock investing, options trading. He sees what I do and looks at the charts and things and has always been curious about it. And he had put together some questions and he's, hey, Dad, can we do this? I want to get into this a little bit more. I have some questions. And I said, sure, send me some questions and let's see what you got. And I was surprised by the questions that he came up with. They're actually very good questions. And I thought that even people who are older, who are new to trading or want a different perspective, they can also learn from this as well. It doesn't matter whether or not you're old or young, if you're new. We are going to go through this. I hope that you guys find this useful. And if things go well, we'll make this somewhat of a recurring appearance. If Will wants to, we'll check in what he's learned and we'll follow along with his progress. If we start trading, he had expressed interest in having me show him some trading things in the options and stuff like that. And if we do that, we'll follow along with his trades and we'll see how he's progressing and things like that. And we'll go from there. So with that, what's going on, buddy? How are you?
Nothing. I'm doing good. How are you?
Doing good. Awesome. So you had some questions for me and let's get into them and ask away. And I'm happy to answer whatever you have.
All right, cool. So jumping right in, I want to know, because I'm obviously new to this, do traders like you look for directional trades or volatility trades? Because I know that's a big aspect of trading. And
so the answer to that is both. When we talk about things like stock trading, like what we're doing with you, just for reference, so you guys know, we started Will with a little stock portfolio, S&P, ETF, and some individual stocks and things like that. Now, these are meant to be for long-term holds. However, to answer your question, in the case of stock trading, I do the same thing, by the way. I don't day trade stocks. I usually will just buy stocks and ETFs to hold long term. So in that case, of course, I'm playing it directionally. I want them to go up over time because I'm buying them, as opposed to selling them. You would want them to go down, but we are playing stocks directionally. That's the way I do it. There are people who day trade stocks and they will buy and short them or buy and sell them throughout the day. But I personally do not do that in stocks. I do that only in futures. So to answer the question, I do look for directional trades in futures because I day trade them. And with futures, there's also volatility as well. So if I'm going long or buying a future for, let's say, the S&P, volatility is good because if I'm long and it starts going up really fast and it goes up a lot, I can make more money. But traditionally it's directional and I want a little bit of a volatility. Now with options, I'm playing options a little bit differently, and we're going to explain in later videos. We're going to teach you about the options positions and how to manage them if you want to, and set you up with your own little account, and we'll follow along with what you're doing. But options trades are more volatility plays, meaning we're selling options and we're trying to collect the profit off of what people are losing. So in other words, most people who buy options typically lose. Somebody has to sell those options to them. And what you typically want to do is you want to sell those options in times of higher volatility because you get more money for it. So options are volatility plays more so the way I trade them, because I don't want to sell an option at low volatility and then have volatility go up, because typically you would lose money that way with the way we play them. And we're going to get into that later on or in future videos and things like that. They're called negative vega trades. Vega means volatility. And if you're short volatility, you don't want volatility to go up. You want it to go down. So options trades are more volatility trades. And the answer is I do both, if that makes sense.
All right. Yeah, so a follow-up question. I noticed you mentioned like ETFs. So like what is an ETF in like the most simplest terms?
ETF is exchange traded fund. So basically what an ETF is, for example, we bought stocks for you. We bought some Disney, we bought some Facebook. Those are just individual stocks. An ETF is a collection of stocks, and it doesn't have to be for an index. It could also be for a set of, for example, Fidelity just came out with a new metaverse ETF. So what they're going to do is they're going to basically say, instead of you trying to figure out which are the hot stocks in the metaverse, for example, you would just buy the ETF. And then their managers, in other words, you don't have to worry about it on a day-to-day basis. Their managers will go and buy and sell stocks within that fund. And then hopefully you can make a profit. Now, there's good points and bad points to ETFs. The bad points to ETFs is that there's going to be bad stocks and good stocks in that fund. So your overall returns may not be quite as much as if you were able to pick the winners individually, but that's not that easy to do unless you're following it every day. There's healthcare ETFs. There's ETFs based off of the whole S&P 500, which is the one you're in. I think it's a VOO. There's also ETFs based off of technology. So these managers will just pick a bunch of technology stocks, Google and Amazon, and all these different companies, and they will just buy and sell within there. They don't tell you what they're buying and selling on a day-to-day basis. You just own the whole basket of stocks in the ETFs. And that's a nice way for people to be able to capitalize on a certain market or sector if they don't necessarily know which stock to pick. Does that make sense?
Yeah.
They even have gaming ETFs, for example. So if you like gaming stocks, but you're like, I don't really know which ones are going to do well or which ones are going to do bad or which ones are overvalued or undervalued or whatever the case may be, you would just find a good fund for that or an ETF and you would just buy that. And again, it's not, the way I play it, it's not typically set for day trading. You would just say, hey, I think gaming companies are going to grow over the next 5, 10, 15 years. And you would just find a good fund that's performed well. And then you just put the money and then you can keep adding to it as you go along and things like that.
So I know this is kind of like a basic question, but does each trader have like their own set of rules, or is it just that everybody follows the same guidelines and fundamentals?
Everybody follows their own guidelines. They all have their own set of rules. There's people who will trade short-term, long-term. There's people that will buy stocks based on fundamentals. There's people who will buy stuff based on technicals. They call them fundamental traders versus technical traders. There's also value add traders that will only buy companies that are really cheap, but that they think that have the most potential, meaning they just got beat down or sold off for whatever reason, but long term, the manager or the buyer thinks that they're going to go up. So everybody has their own set of rules as to what type of trades they do. They also have their own set of rules as far as the criteria that they have to enter the trade. And that goes for anything. That goes for stocks, options, futures. Forex is basically just another tool. It's called foreign exchange. It's based on the currencies in the market, like the dollar and the US dollar and the Japanese yen and the different currencies that are out there in the world. But no matter what it is, all traders have their own set of rules and criteria to get in the trades, if that makes sense. So you would have to come up with your own, you would come up with your own plan. And for example, if I'm going to teach you the options, for example, we have rules as far as when do we get in? How do we get in? When are we allowed to take certain trades? How far away as far as duration until these options would expire? We have specific criteria that we would teach you, and then you would be able to just put those trades on. And then there's not only criteria as far as entering the trade, but there's also criteria as far as managing the trades. When do you get out? When do you take profit? If there's a loss, how do you know when to get out so you don't take too big of a loss? Because all traders have losses. It's just you have to set it up and structure it in a way where you don't take big losses. You can't have like $100 winning trades and then lose $5,000 on one loser, because then, okay, sure, you went 10-1 as far as win losses, but you lost way more than you won. So you have to have,
you're not profiting.
You're not profiting, right? So it doesn't matter. You could win 99 times and lose one time. And we can get into that down the road, because that is an actual thing, even for medium to advanced traders. They don't understand that win rate is important from a psychological standpoint, because if you're losing all the time, unless you have real confidence in your system and your methods, you could get discouraged. But there are traders that only win 30% of the time, but they actually make money. And the reason is when they lose, they're only losing the reverse of what I just said. They're only losing, let's say $50 on a losing trade, but they win 5,000 on a winning trade. So you could be 30% theoretically and still win. But when a trader is coming up and just learning, and it doesn't matter what age you are, to build your confidence, you want to have a system that has a higher win rate just because you feel like, hey, I'm winning. As long as you keep your losing trades under control, you're okay.
Mm-hmm.
You follow that?
Yeah. Yeah.
Okay.
So yeah, you don't want to get, it's like gambling. You don't want to get too carried away with your losing trades. You know?
Gambling is a little bit different. Gambling is making a bet where you don't have any kind of defined outcome, but I don't really necessarily believe that 100% either. But you don't really have as much of an edge with gambling. In fact, you may not have an edge at all. Like, for example, if you play a game called blackjack, you played blackjack. We played blackjack together before. In the casinos in Las Vegas or wherever have a 50, I think it's a 51-49 edge. So they only have a 2% edge. They're playing the same way every time. And they know that over time, because of the way other people play, and not everybody's playing by the rules, that they're gonna be able to win. And you say, that's only 2% difference. How could they make any money that way? The difference is they're taking bets thousands of times a day for millions of dollars. So it adds up over the course of a week or a month or whatever, but they don't have that big of an edge. There are other games that they have in there, like slot machines, where they have a higher statistical percentage and edge. And that's why typically casinos will win all the time. But for the gambler, typically it's a losing proposition. The only way gamblers typically make money is they have to know when to leave. In other words, they have to say, okay, if I get up a certain amount of money, I'm going to just walk away. And they have to know what that dollar amount is based on their history, how they've done and everything. And even then, there's no guarantee. With trading, it's different than gambling. And the reason it's different than gambling is that you can actually go and back test these trades, meaning you can go and put them through a simulator where you can go back years, decades, and you can say, okay, based on what I did, and I played it the same way every time, would I have won? What percentage of the time would I have won? It's called back testing. And you could actually develop methodologies if you can get the rules right, which we talked about the rules, where you can say, I could take this trade and I might lose 3-4 times in a row in a couple months, but over the course of a year, every year for the last 10 or 15 years, this thing's going to make me money 80% of the time or 70% of the time. And this is how much percentage I can get out of it off of my investment. So you have an edge. You can have an edge if you've got the right rules and entry rules and management rules and everything like that. That's different than gambling, because with gambling, the gambler typically doesn't have an edge. The house or the casino typically has an edge. Does that make sense?
Yeah. Okay. So it's very different. Yeah.
Wait a minute though now, but also, unfortunately, there are a lot of traders that treat trading like gambling. They just don't understand the need for the rules. They think they're going to just go in and based on feel or based on the market looks like it wants to go up today, so I'm going to throw some shares on here in Facebook or whatever, and I'm going to buy, because you can't fly by the seat of your pants like that. You have to have very distinct set of rules that you look for getting in and getting out. And unfortunately, I've seen a lot of traders, too many traders, treat it like gambling. And in some cases, that's not their fault. In some cases, they just haven't found their edge yet. And they don't want to take the time to learn the edge without using real money. So they basically just throw it on and they just lose, because that's gambling. So there are a lot of traders that do gamble. I don't ever put on a trade, whether it's in futures or options or anything like that, because it's such short time frame. I got to know that I have an edge. Now with something like stocks, like with what we're doing with, we bought for you, let's say Facebook, we know with Facebook, they got beat down. We talked about that. And it might be a while before Facebook gets some steam again and catches up, maybe because of the metaverse, maybe because of something else. We don't know. So we're not expecting this to do anything in a short period of time. We're going to hold it and see, and maybe we'll even add more if it goes down, depending on what happens. But very different. Very different.
We will return to the show in just 1 second, but I want to ask you if you are a futures day trader. If you're a futures day trader, I'd love for you to check out our Community Pro Premium subscription. In addition to our daily live trading room in the mornings, You'll get pre-market levels on all the major markets we trade, help from the moderator with trade management, and everything else the community offers. Check out all the details of what's included in the Community Pro Trading section of my website, www.rickmazur.life. That's www.rickmazur.life.
Do you personally trade from like the technical side or the fundamental side of the market?
I trade technically, especially with the day trading and the medium term trading. And when I say medium term, usually with futures, and again, everybody does it differently. There's people who trade futures, they call it position trading. And that means they'll buy futures and they'll hold it for sometimes 2-3 weeks or more. That's a little dangerous with futures because futures are very expensive. So if it goes against you because of the leverage that you're given with futures, you could make a lot of money in a short period of time, but you can also lose a lot more money, like 10, 20, 50 times the amount as with a stock. So I always enter based on technical reasons on what I think that what the other traders are doing. 95% of traders lose. So part of the criteria for me entering trades for futures is understanding that 95% of the traders lose. And if I know where they're buying or selling and they're losing, then I would just do the opposite. Essentially, I would play along with and I know you had some questions. I don't have them in front of me, but you had some questions about HFTs and high frequency traders and all that. We'll get to that down the road. But if you know, in other words, what they're doing, I'm basing it off of the charts and off of the technicals of what's going on. Fundamentals, I will use only for longer term plays. And even then, it's really more for me. Honestly, it's more for feel. If I like a company, I will look at their fundamentals to see if they're overvalued or not. For example, you were looking at what you were looking to buy. Which stock was that?
Pfizer.
You were looking to buy Pfizer. And remember, I pointed out to you that it was overvalued by 8% or whatever. Now, that's just one analyst opinion of it, but they are overvalued in my opinion currently right now. I mean, we're recording this April 24th, 2022, but doesn't mean it can't keep going up even though it's overvalued. But so that's an example of fundamentals. You're looking to see, is the stock cheap comparable to where it's traded in the past? And there's other things that you can learn too about multiples and things like that. There's earning multiples that stocks typically trade at in different sectors, like healthcare or technology, usually trade at different multiples. For example, Netflix lost a bunch of subscribers and their stock was up at $700 or something a couple months back, and it's down to $200 and something right now. So on a fundamental basis, Netflix is very cheap because it's only trading at I think 18 times multiples. Now, an 18 multiple, a stock like a soap company or Johnson, some sort of a company that's been around for a long time. Yeah, that's an expensive multiple, but for a technology company, an 18 multiple is typically cheap. There's companies like Tesla and Amazon that are trading at much higher multiples than that. So it's technically cheap from a fundamental standpoint. However, just because it's cheap doesn't mean it's necessarily going up. If people don't believe that Netflix is going to make a lot of money or their subscriber growth isn't going to go back, it could sit here for a long time. Sure, could it go up $100, a couple $100, maybe. But then what is it going to do from there? And even then you could make a profit from that. If you buy it 220, 250 or two, whatever, and it goes up to 300-400 for a short-term trade, you could make money, but I would not hold it thinking it's going back up to 700. So when we talk about fundamentals, that's what we mean. And I only do that with stocks personally. There are people that they buy options the same way. In other words, you could buy options betting that Facebook would go up or that Amazon would go up or whatever. People do that. I don't personally trade them that way, but there are people that do that and make a lot of money because you're getting more leverage and stuff like that. There are negatives to doing that as well with options because there's expirations with options. In other words, if I buy a stock, like you hold a stock, you can hold it forever. It never expires. With options, there's always a time limit on them. And again, when I start teaching you about that, we'll learn about that, but there's always a time limit. So if I'm betting that Netflix is going to recover and go up, I got to know the time frame that it's going to go up as well. If I get the time wrong, it could still go up, but I'm already going to be out of the trade because it's going to expire and I'm out of luck. There are things you can do to extend the trade by rolling positions and things like that. That's more advanced stuff that we'll talk about later. But so again, I mostly do technicals. There some fundamentals, but only with stocks.
Yeah, I know you said you trade the technical side. So why'd you pick the technical side of the market?
And the reason is because when you're day trading, there really is no fundamental. Because it's such a short time period. You're talking about, and some people only trade like me. A lot of times I'll only day trade in the morning. So you're talking about 2 or 3 hours. So there's nothing fundamentally is going to happen in most cases, unless there's news. Like if there's news or earnings, but even then I'm not entering the position based on that. I'm entering the position of, okay, earnings came out and the market and the instrument, whatever it is that I'm trading, is going up fast because there was good news or something like that. I'm not entering just because I heard that they beat their earnings and they're growing their subscriber base. I'm still looking for a technical trigger on the chart to get me in. So for day trading, I don't know too many people that really do day trading off of fundamentals. It's really news because it's such short-term news moves. For options, again, it's hard to pick short to medium term what something is going to do fundamentally. So fundamentally, like I said, you can say fundamentally, I'm looking at everything and I believe Netflix is going to recover and I believe that they're going to be the king again and they're going to be back up at 700. Great. You may be right, but you don't know short term whether you're going to be right. And the only way you can really trade fundamentally, in my opinion, is longer term. Because most of my trading is done short to medium term, I pick technicals. And I think most people do if they're trading that way. But that's the reason.
All right. Yeah. What's your favorite asset class to trade? And whatever it is, why do you like to trade that one?
My favorite asset classes, derivatives, are different than stocks. For example, there's a lot of different derivative things that you can trade, but they're basically just different from your normal traditional set of investing. And what I mean by derivatives is futures, options, and things of that nature. The reason why is because of the leverage. So in other words, if I'm trading a stock, for example, and let's say Netflix, we'll just stick with Netflix. $200 a share, let's say $220 a share. If I want to make, let's say $1,000 on a trade in Netflix, I would need to go and put $200. I would need to put, let's say I put 1,000 shares. Okay. I would need to go up $1. Now that might not be that big of a move in Netflix. You might be able to say, I can get more than $1 on that on most days. Let's say you want $2. Then I need to put 500 shares on. The issue with that is that if I want to put 500 shares on in Netflix, and there's things that are called margin where you don't have to put up the entire amount of money, and we can get into that at a later date. But just to keep it simple, if it's $220 a share times 500 shares, I need $110,000 to basically put on. And it's less than that because, like I said, the broker gives you like a little bit of leverage, sometimes 3, 4, 5 times leverage. So maybe you don't need 110,000, but you need tens of thousands of dollars to put that on to try to make $1,000 or to try to make $500. Same thing if you're trading any higher edge stock. The lower price stocks typically don't move as much. So if they're big companies and they're lower price, they typically don't move as much because they're typically more mature and things like that. So the reason why I choose the derivatives is because if I'm looking for, say, $500 on a trade or $1,000 on a trade, I can say buy crude oil. I want to buy crude oil futures and I want to do it day trading. I can do that with 2 or 3 contracts instead of buying 500 shares of Netflix. And I only have to put on with my broker, it's $1,000 a contract. If it's the S&P index, it's only $500 a contract. So if I need to put, say, 3 contracts or 4 contracts on to make $1,000, I only need to put margin capital that I'm putting up is only a couple $1,000, $2,000 to $3,000 or $4,000. Whereas with Netflix, because you're not getting the leverage, you're actually putting on 10, 20 times that you're risking your capital that you have to put up in margin. So you can make more and risk less, essential, with trading the derivatives. And when I say risk less, you're still risking probably the same, but you don't need as much capital to put up. Your wins and losses might be relatively the same dollar wise, but you don't need as much capital to put in to make that same amount of money. So in other words, if I want to make $500 in a day with a stock, I'm going to have to trade so many shares that I'm going to have a huge account. I'm going to have if we're using Netflix as an example, I'm going to have a $30, $40, $50,000 account. I can make the same money on the same trade in crude oil with the $5,000 account instead of a $20,000 or $30,000 account. So that's why I do that. Now, there are people that just prefer stocks. They have a bigger account, but most people don't have huge accounts. And that's why when people have smaller accounts, I recommend that they start with futures. And you can even trade what they call micro futures, or even with Forex, with the currencies. They're called nano contracts, micro and nano contracts, where you're talking about $3 or $4 for every point move versus $50 with the normal contract. So you can come in with even $400, $500, $600, $700 account. And now you're not going to make as much with the $700 account because you're going to have to trade the micros, which is smaller. But the point is that I use the derivatives because I'm getting the leverage. The leverage allows me to risk less and make the same dollar amount. And I don't have to have as much in my account to do it. That's basically the reason.
All right. How do you choose your stops when you're trading options? Because I know that's like a huge thing in options when you want to pull out.
Again, the way I trade options, I don't use hard stops. What a hard stop is basically when you're in a position, you will set a price. And if that option price gets to that level, you're out and you lose whatever you lose. The reason why I don't do that with options trades is because I'm hedging. So my positions are never one direction. I have a built-in hedge with my position, meaning it's like insurance. I have insurance if it goes against me to where I'm not going to get killed without being able to do something about it. And because we were talking about the volatility, the reason why I trade options is with volatility. The volatility will work in your favor if it goes in the direction you want it to, but it will go temporarily outside of your favor if volatility goes up. So basically, if you use a stop with options, the way I trade them, you can get stopped out of your position and it can end up doing exactly what it's supposed to do anyway. So I don't do that for that reason and because I've got the hedge built in. Now, with futures, I do use a stop. And how do I choose my stops? Based on the technicals and based on the support and resistance levels. So if I'm looking at a chart, for example, and I think the market's going to go up and I can make a certain amount of money on a trade, I know where I'm wrong. And this is where traders need to learn. They need this part of learning the system. If I'm going to take a trade and it's going to be too far away before I'm wrong and I have to take a bigger loss, that's not a good trade to enter on. Part of my entry criteria is that I will only enter the trade if I can set my stop to a point where if I'm wrong, I'm only losing a certain amount of money. And that's based on, everybody's different because some people try to make $3,000 on the trade. And if you're making $3,000 every trade, you could afford to lose $3,000 if your win rate is okay. But so it's different for everybody. But I set my stops. I choose them based on being able to get in and knowing where I'm wrong. And I set my stop below where I'm wrong. So if I say I'm going to buy here and I think the market might wiggle around here, it might go up a little bit, it might go down a little bit, but I'm not going to be down that much money. It's an acceptable loss if it wiggles around there or being down temporarily, because you never lose until you're actually close the position. So you're temporarily down. It's called intra-trade P&L, meaning you're up or down in the middle of a trade, but you haven't won or lost unless you lock in a loss or lock in a profit. And again, when we get more into the charts, we're just doing this as a podcast right now. Everybody who's listening to this is primarily listening to it as a podcast. We are recording video and it will be on YouTube, but because it's more of a podcast audio format, we're not doing charts today or anything like that. But if we do another one where we do charts, I will show you exactly what I mean about there being a trade somewhere, but I can't enter it because there's too big of a potential loss. And even if I put my stop there, I would get stopped out and it would still work. Because I can only risk so much. So you wouldn't take that trade. You'd wait for the next setup. And I could show you on a chart where it would make more sense. And anybody who's listening to this, if you subscribe to the podcast, or if you're watching it on YouTube, you can subscribe to the YouTube channel. You'll get alerted. If you select the notification bell, you'll get alerted when these new videos come out. I'm going to have Will on, hopefully in a recurring situation like I talked about earlier with his own account. And then I have other traders on as well, who are older traders who need help as well. And we talk about that. So you'll get to see that, Will, and people who are listening will get to see more what I mean on a chart about that answer. Stay tuned for part 2 of the show coming soon.
So that's it for today's show. Let me know what you thought of it. I'd really appreciate it, and it will help make these shows better for you. Feedback is a very valuable tool to get better at anything. You can hit me up at Twitter at RickMaz1106, that's RickMaz1106, or on Instagram at RickMazur1, RickMazur1. Use the contact form on the website, rickmazur.life, and we'll also have everything in the comments section for each show page. I personally look at all the feedback on the site as often as I can. Finally, if you have anything to contribute or ask, or would like to appear on the show through an interview or one of our other segments, you can leave a voicemail at 1-800-590-0174, or by contacting us on any of our socials, or use the contact form on the site. We'd love to hear from you. I consider us all a community, a group. Let's remember, in today's more challenging world, we are people first. We're humans who just want to be treated as such and live in a place where we can all prosper and live well. Bye for now. Until next time. See ya.